Yeah, I've got gold going to $10,000, which at this point is, I'm not giving a lot of thought to it and followed it for a very long time. That's kind of a commonplace projection. You know, you go on the web and podcasts and everything, gold's going to go to $10,000, et cetera. So, you know, what's the value added in that projection? I would say that it's going to hit $10,000 a lot faster than people think. And there are some interesting reasons for that. I mean, we can go into the fundamentals and explain why gold's going up. I'm happy to talk about that. But in terms of that price target and getting there, probably in 2026 and maybe not even that far into the year. I always like to keep the math at the fifth grade level, at least when I was in fifth grade. You know, but there's a behavioral psychological phenomenon called anchoring. And the idea is you get an idea in your head, it could be a number or a theme or whatever, and you anchor on it, and then you begin to filter all the data you're getting through that anchor, and it can change, but that's a very, very common phenomenon. We're not at the frenzy stage yet, which is important because retail's not all in. I mean, I was just down in Australia not long ago with friends from ABC Bullion. They have an office in the central CBD, central business district, and a friend of mine sent me a picture the other day. They were queued up around the block waiting to get in to buy physical gold, but that's recent.
Very recent.
Yeah, well, that's right.
It doesn't happen around here.
It does not happen in the United States. The U.S. will probably be the last to get there. You know, it's happening in China because they don't have too much else to invest in, and it's sort of caught on in Australia. Bearing in mind, you got to take in their currency is going down against the dollar, so gold's going up even more in terms of their currency. So these are kind of at least mild psychological effects that go beyond the fundamentals, and again we can talk about the fundamentals, but yeah, it's if you take 1971 to 1980, so gold went up 2,300%. But another way of thinking about it is that gold didn't do anything. It's gold, atomic number 79, it's an element. As you put it in a drawer, come back a year later, open up the same amount of gold. So what's really happening when gold does something like that? Well, what's happening is the dollar is collapsing. So if you measure by weight of gold, and that's it's not arbitrary, but it's just a metric, measured by weight of gold, the dollar declined 95%, approximately 95%. So there's your dollar crash. Everyone's like, when's the dollar going to crash? Well, it did, measured by weight of gold. So that's starting to happen again. And that gets into a much bigger narrative. You know, when you say what's going on with gold, there's a narrative. Wall Street loves narratives. Some of them are completely just wrong. They're kind of made up because Wall Street always needs a story to sell you stuff. Some of them are they're self-fulfilling. Like they start out not true, but they become true because people buy into them. And then some of them are right. So you can't just say narrative. You gotta, you know, Robert Shiller wrote a good book on this, but you got to figure that out. But the narrative. Let's start with the narrative, which I think is almost completely wrong.
When gold appears to explode, the metal itself isn't changing. Its atomic identity remains constant. The shift reflects the weakening purchasing power of currencies, especially the U.S. dollar. From 1971 to 1980, gold surged over 2,000%, but the real story was a 95% collapse in the dollar's value when measured in gold. Today, early signs suggest the dollar may be entering another long-term erosion cycle. Investors often ask when a dollar crash will occur, without realizing that a gradual decline, measured against stable assets like gold, may already be unfolding once again.
Yeah, I've got gold going to $10,000, which at this point is, I'm not giving a lot of thought to it and followed it for a very long time. That's kind of a commonplace projection. You know, you go on the web and podcasts and everything, gold's going to go to $10,000, et cetera. So, you know, what's the value added in that projection? I would say that it's going to hit $10,000 a lot faster than people think. And there are some interesting reasons for that. I mean, we can go into the fundamentals and explain why gold's going up. I'm happy to talk about that. But in terms of that price target and getting there, probably in 2026 and maybe not even that far into the year. I always like to keep the math at the fifth grade level, at least when I was in fifth grade. You know, but there's a behavioral psychological phenomenon called anchoring. And the idea is you get an idea in your head, it could be a number or a theme or whatever, and you anchor on it, and then you begin to filter all the data you're getting through that anchor, and it can change, but that's a very, very common phenomenon. So people will look at gold, and they'll have a number, let's just say $1,000 an ounce. So it goes from, you know, $2,000 an ounce to $3,000 an ounce. Now it's made its way to $4,000 an ounce. And that took a while, it took a couple of years. I mean, percentage-wise, these are good gains, but that took a couple of years. So they go, oh, well, $10,000 just seems like the dark side of the moon. It's going to take forever to get there. But the math is that so if you have 50 ounces and it goes up $1,000 an ounce, you made $50,000. Okay, it goes up another $1,000 an ounce, you made another $50,000. So you're anchored on the $1,000 steps and the $50,000 you made, which is all true, and that doesn't change. But when you go from 2,000 to 3,000, that's a 50% gain. When you go from 3 to 4, that's only a 33% gain. Well, when you go from 9 to 10, that's only an 11% gain. That's like a good month the way gold's been trading lately. So the point is, people kind of lose sight of that. So yeah, 3 to 4 made it, 4 to 5 getting there, but you're going to go 7, 8, 9, 10 really quickly because those are smaller percentage gains.
Yeah.
And that's something that people, they extrapolate 2 to 3, how long is it going to take to get there? The answer is probably not very long.
Gold price targets of $10,000 per ounce have moved from fringe predictions to mainstream debate. The surprising part isn't the target, it's the timeline. Behavioral anchoring makes investors expect slow, stair-step increases. They recall the years it took gold to climb from $2,000 to $3,000 and assume similar delays ahead. But percentage math accelerates at higher price levels. The jump from $9,000 to $10,000 represents only an 11% gain, achievable in weeks under current volatility conditions. If momentum continues, gold could approach $10,000 much sooner than widely expected, potentially as early as 2026.
It's important because it's what you hear, like you go again, podcast, web.
So this is like
CNBC.
macro tourist type narrative on why gold's going up.
Correct. But then there are real reasons why gold's going up.
So let's do both.
For an investor, it's important to get the real reason. So the narrative is the U.S. is $37 trillion in debt. Actually, it's just got to 38 the other day. So I have
The debasement trade.
The debasement trade is exactly what it's called.
I just summarized Luke Roman's entire being.
Well, he might be in part of the narrative. So yeah, $38 trillion of debt. The highest. It's too much. We can never pay it off. Well, first of all, quick aside, we haven't paid off the national debt since Andrew Jackson. 1836 was the last time the United States was debt free. So you're never going to pay it off, and you don't have to. They have 38 trillion, banging the table, boom, boom, boom. China's dumping treasuries. Everyone's dumping treasuries. Bond vigilantes are saddled up. Interest rates are going up. Interest rate on the debt alone is greater than the defense budget. U.S. is going bankrupt, et cetera, et cetera. Buy gold. Everything I just said is false. I mean, it is the narrative, but let's just kind of put that in context. Number one, the debt is $38 trillion. That's looking at the liability side of the balance sheet. You got to look at the asset side. 150, 200 trillion, don't know. Are we going to sell Yosemite? No. We're going to sell the Grand Canyon? No. But there's an awful lot of mining rights, mineral rights, oil, natural gas, Gulf of America, intellectual property, none of which the U.S. has monetized very effectively, a lot of which we actually squashed.
Market commentators often frame gold's rise as a response to exploding U.S. debt, now above $38 trillion. The storyline suggests national insolvency and imminent collapse. But this view ignores the asset side of America's balance sheet: vast mineral rights, energy reserves, intellectual property, and federal land. The U.S. has never paid off its national debt, and it doesn't need to. What matters is the debt to GDP ratio, not the raw number. After World War II, debt surged, but the ratio fell from 140% to 32% because economic growth drastically outpaced debt expansion. The same mechanism remains possible today.
So I'll give Scott Bessent credit for that. He's trying to monetize the asset side of the balance sheet. So that's one thing. Number two, you don't have to pay off the national debt. In fact, we're not going to. You don't even have to pay it down. So the key metric, and the only one that really matters, is the debt to GDP ratio. What is the government debt to GDP? And one way to think about that is, let's say you owe $50,000 on a MasterCard. Is that a lot or not? Well, you can't answer that question without knowing how much money you make. If you make $20,000 a year and your interest rate is 28%, you're probably going broke. If you make $500,000 a year, you write a check and it's done. So you have to put the debt in the context of the income. That's why the debt to GDP ratio is powerful. Now, Right now, it's about 123%. 37 trillion of debt, GDP's 30-ish, 29, 30. So it's 123%, which is the highest in history, and that's not a good thing. I'm not sloughing it off or saying we should ignore it. It's not a good thing at all. Highest in U.S. history. But at the end of World War II, it was 114%, which was the highest at the time. Of course, we won the war with our allies, so that was good. By 1980, at the end of the Carter administration, when Reagan came in, that number was 32%. So how did we get from 114% to 32% in terms of the ratio, which 32 is very comfortable, by the way. It's like practically having no debt. One thing we did it. It took 35 years, from 1945 to 1980. One thing that impresses me about that accomplishment, it was completely bipartisan. You had Democrats like Harry Truman, JFK, LBJ, and Jimmy Carter. You had Republicans like Dwight Eisenhower, Richard Nixon, Gerald Ford.
The sustainability of U.S. debt depends on nominal economic growth. If the economy grows at 5% annually, while debt grows at 3%, the debt-to-GDP ratio declines, improving the nation's fiscal position even as debt rises. With current nominal growth hovering around 5 to 6%, the path to stabilization exists, although it will require consistent policy discipline. Major institutional investors, sovereign wealth funds, pension systems, university endowments, watch this metric more closely than the headlines. For them, direction matters more than temporary spikes. If the ratio trends downward, even slightly, confidence increases and long-term risk perceptions improve.
But it was not, they politicized everything else. They could argue about lots of stuff. They did not argue about that. They said, we gotta get this down. Now, here's the bottom line. The national debt in 1980 was 3 times what it was in 1945. The deficit, annual deficit in 1980 was 3 times what it was in 1945. So the deficit tripled, the debt tripled. Well, how the heck did we get the ratio from 114 to 30? The answer is growth.
Yep.
Growth was 10 times, and that's the key. So this is what Scott Besson is working on. He calls it the 3 arrows, which is fine, not the Japanese 3 arrows. But he says if you keep deficits at 3% of GDP or less, and get real growth at 3% of GDP or more, notice I said real because when you do debt analysis, you have to use nominal debt. So with 2% inflation, which is low, but 2% inflation, your nominal growth is 5. And then he wants 3 million additional barrels per day of oil production, which will help keep gasoline prices down. But just take the first 2. If the debt's growing at 3% a year, and the economy's growing at 5% nominal, 3 plus 2, then the ratio is going down. And that's all the market has to see. And if you did that for 1 year, your debt to GDP would go from 123 to 121. Everyone's like, hey, 121 is still pretty high. Yes, but it's moving in the right direction. We're sort of replaying what we did after 1945. Now, so the math is simple. The math is simple. The plan is straightforward. Whether you can pull it off or not is a different question. That's a policy question, and that's what I'm watching.
A popular narrative claims countries, especially China, are dumping U.S. Treasuries. However, official Treasury tick data shows foreign holdings largely stable. When countries sell treasuries, it typically signals a dollar shortage, not distrust. Nations need liquidity to support their currencies or stabilize domestic banks. Treasuries remain the world's primary reserve asset because they provide liquidity that physical dollars cannot. If widespread selling ever emerged, it would indicate stress in the global monetary system, not a rejection of U.S. credit. For now, no such trend exists, but the underlying vulnerabilities are worth monitoring as gold's appeal escalates.
Nominal growth right now is about 5%. It's 2 plus 3.
Yep.
Now,
It's some quarter. I mean, this quarter it hit 6.
well, it might be 6 exactly.
Yeah.
But if it's 6 and debt's going at 3, then your ratio is going down, and that's all the market needs to see. The big money, your clients, the sovereign wealth funds, the endowments. That's what they're looking at. That's a smart way to think about it. So debt's not going away. It's getting bigger. Deficits are not going away. They're getting bigger. But if growth is sufficient and it's nominal growth, not real, that ratio goes down and we're in good shape. Now, take the next part of the narrative. Everyone's dumping treasuries. Well, again, I always find it's good to stick to facts. The Treasury Department has a monthly report called the Tick Report,
Yep.
and it's basically, it's a simple spreadsheet, and it's like all the countries in the world and what treasuries do they own and how many U.S. treasuries do they own by maturity. You can look at it. It's not going down. And the Chinese, about a year ago, they sold a little bit. I'll come back to that. But they're not. That's very constant. They're not loading up, but they're not dumping treasuries. That is just not true. And you can look at the Treasury data and you can see it. Now, if they do sell treasuries at all, they actually wish they had more. They're not dumping them. That's nonsense. They're desperate for dollars. And this is where people get thrown off because, like, oh, the dollar is the leading reserve currency in the world. Well, not really. It's because reserves are not held in cash. They're not pallets of $100 bills. They're assets. And securities are not money. So U.S. Treasury securities, yes, that is the #1 reserve asset in the world. It's denominated in dollars, so let's think about dollars. But they're not actually dollars. If you want dollars, you have to sell the Treasury and get the dollars. If China does that, why? To prop up the currency and prop up their banks. That they wish they had more dollars. So, so the dumping Treasury narrative is not true. The data shows that they've been pretty constant. They're not loading up, but they're not dumping them. They're just rolling them over. But if you do see them selling, don't take that as a signal that they're dumping it. Actually, that's a very distressing signal because it means there's a dollar shortage, which kind of precursor to maybe a global monetary crisis. I'm not forecasting that, but that's one of the things I'm watching.